for F&B sector, rather, across developing markets.
Well, I'm a corporate lawyer within Dentons, specialized in private equity, and we assist firms like Mediterra with their acquisitions. We're coming across quite some investments in F&B, and in deals where we are involved, it's mostly about the large change, the franchise change, where locally investments are being taken.
Right. So the first question everyone asks in this industry when you want to deal with a PE is obviously, what is a PE house looking for before they even consider dealing with you? Robin, what are you looking for?
We have a kind of simple philosophy. We're looking for food of the future. I mean, really has to be best of class, number one or number two in the space. Could be Spanish, Italian, whatever, Japanese. But it has to have something about it which is defensible. We have to make sure the food offer is probably slightly complex enough to keep other people at bay. We are very focused on decent financial metrics, and when we look at a 10-site business, I'm looking for consistency. So, you know, it's all very well having a couple of trophy sites and then a load of dogs. That's not going to work. We want something that gives us some kind of common sense of progression going forward. And then, you know, there's no point, it's a marriage. You're entering into a long-term relationship, and the only other ones are getting married, that I can think of, that go on for 5 years plus, hopefully more. And so you're looking for people you can want to be in a room, frankly, you know, and have a bit of fun as well, because otherwise it's just a bit painful.
Well, Chris, you operate at a slightly different level in terms of size.
Yes, but very similar things that we look for. So it's really three things. A total obsession with the product. Yeah, I'm not a chef, and I'm not going to be in that business every day, so the founder has to be totally obsessed with what they're doing and doing something very special. Second thing, as Robin said, is it's the people. I must say there are easier ways to make money in this world than restaurants, and so you need an incredibly strong management team. And finally, I'm not in this to create art for art's sake. We need to make money, and so there needs to be a scalability to that restaurant. Now, that doesn't mean opening 30 restaurants a year. I actually think that world is a quick way to ruin a brand. But yeah, some way to expand that brand, be it through diffusion brands and new sites, etc.
Okay. Just for the sake of controversy, Ahmet, I think you come from a completely different space, different geography. Scale is always an issue, but we've seen you implement a slightly different strategy than that. How do you see it? How do you look at an investment when it's presented to you?
Well, I think we invest not only in the sector, across different sectors, and fundamentally, when you look at a business, you're looking for a good business. So it's no different in the sector. We're looking for a concept, a product, a concept that can be attractive to a wide audience so that it can scale up. So we're looking for competitive advantage, you know, what's different, what's special. We're looking at good financial metrics, unit economics in particular. Is it attractive? Therefore, can we scale it? Can we find the right management team to manage it? Is there already an existing one, or do we need to bring in? And then we, of course, have to worry about how to exit the business, and because, you know, it could be 4, 6, 8 years, but eventually we will sell and exit the business. So we look at all of those things, and I think I would like to underline here, as I think Robin alluded to it, private equity is not, you know, a single consistent group of people. In fact, you know, you have many, many different styles, characters, and you guys see this working with different private equity firms, cultures, approach to business, approach to entrepreneur, approach to management. So we, of course, do our due diligence, but the company owners have to do their due diligence to pick the right partner for their business. And be prepared to scale the business and eventually exit it. Otherwise, it doesn't make sense to partner up with private equity. Could be different with venture capital, but for private equity, that's how it works.
Ahmet, a question. I know that private equity firms, they really would like to be sort of ahead of the curve. They seek a strategy anticipating GDP growth, change in consumer behavior. Do you have a specific view on changing strategy as far as investments in F&B in your region is concerned?
So I think yesterday, and I'm sure today we will as well, we've heard many things exactly to that point, right? The consumers are going for experiences, they're going to socialize, they go out to have dinner, lunch with friends, with leisure activities, and so on and so forth. So that's why we're excited about the sector. That's global. However, when you look at, especially across the world, you have this huge population who's coming out of poverty into middle income. That's, you know, China, India, Africa, Turkey went through this over the last 15 years. And I think what we see as an opportunity there, people are bored and not satisfied enough with the typical quick service restaurant concepts. And they want something more, but they don't want to pay a lot more. So, we believe this can be done. We have invested in a format that does exactly that, provides a casual dining experience for, you know, €2 more compared to a big chain menu, let's say. You can actually have a casual dining experience with excellent food, good service, and so on and so forth. So when you have that winning formula, that can scale. And with us coming in and putting in the right management team, right infrastructure in place, we can get that restaurant to scale 50 restaurants a year. And we can take that restaurant across different markets where it's applicable. The same thing can be applied. So that's quite exciting. And I think the whole industry, especially that part of it, is due for massive disruption.
I think there are other things. You need to be fresh, healthy, relevant, Instagrammable. You've got to be socially, active. It's a different playing world. 5-10 years ago, you've got very sexy concepts, and it's just but they are, and then the danger is, are they too niche, and can we grow them? And it's a whole,
It's a difficult balance there, and actually I think we focus mainly on London at the moment. To just do great food, you'll last about 2 years in London. Yeah. You have to be offering a hell of a lot more, the experience.
And prepared to innovate.
Exactly.
Well, that brings us to the next question. We're all operating on different markets. Running a restaurants business in Russia or in Turkey is definitely not the same thing as in UK or in Dubai, where the income levels are completely different. Robin, in your experience, how do you approach that difference in the markets? What are the key concerns?
Well, last week I was in New York and Miami, where we have restaurants, and I was in Dubai the previous week. So, this kind of strange world we live in. There are some universal truths. I mean, people do eat out for social occasions. Sure. And there's a universality of people in transit. If you live in the airport world, it's the same. It really is. People at SSP got it licked. So it's not so different. But, even in Miami, we have this amazing tacos bar with Bob Marley's children doing the turntables behind us in this lounge bar. And I'm thinking, this is so cool. But you can't, you have to be personalised to the area. And, and there are certain regional specialities around, say, Latino food. You just have to get it right. So and what you can do in UK, you couldn't get away with in Miami. It has to be just perfect. Yeah. So I just think you have to listen to local operators. You have to be really humble. I know, having open restaurants with a few people who work with me in Yo, we went around the globe, and you have to be much more sensitive these days and have local operator input. I never go in arrogantly. I'm just intellectually curious about what makes things work. And the truth is, we will probably get it right, hopefully 8 out of 10 times. And we might pick some turkeys. It's not because you haven't done your due diligence, but there was something subtly different about the people's appetite for that concept. And it'd be around the food, it'd be around the proposition, it'd be around the location, and what is it that is almost unwritten about that business that you didn't see when you bought it. So that you have to sensitize. And there are certain places in the world which, people should be fearful to tread. I mean, I know Manhattan, nightmare. I think London, nightmare, unless you know what you're doing, because you can very quickly have your money taken away from you.
Yeah. Knowing what you're doing is obviously key. But Chris, based on previous discussions and the scale and the size, we had a very interesting discussion around large chains and what's happening to them. They were the pioneers of franchising in terms of driving growth, but these days we see them struggling.
Yeah, and it comes back to my previous point. Private equity historically has stuck a chunk of cash in and rolled out as aggressively as possible, and not tweaked that offer to the market or innovated as they've gone along. And so I'm in quite a lucky position where I've got 4 brands, and actually each of them opening 2-3 restaurants a year. As a group, it's growing quite quickly, but what it means is the founders of each of those businesses can really focus on each of the properties and making sure the food, the experience, and everything is tweaked to that location. And it's something I had beaten into me in my days at Soho House. Nick opened up Soho Houses around the world, but each of them, they had the ethos and the feel of Soho House, but they are tweaked to each location.
Well, controlling the speed of growth, is that key? Would you always have an eye on keeping enough for a second investor to come in and to be able to grow?
Yeah, and I mean, it also depends on the concept. So I have a poke concept called Island Poke, and that one is much easier to scale. It's a bit more of a cookie cutter. I mean, we still try and edit it slightly for wherever we're putting it. And other brands are slightly more complicated. So I have a Chinese brand that actually, in its current format, we wouldn't do the same one. We're going to do similar to like a Mamafuku in New York, different versions of that piece. But I think there's a new way to expand brands without just saying, let's write a manual. Although then it's trying to find, you've always got to keep an eye on who's going to buy it afterwards. And so there does have to be a clear path. So if you have a few diffusion brands, how do you grow each of those?
I mean, it's a different ballgame for you.
Okay, yes. On that point, I just want to say, well, at least we believe that whatever business we invest in, we're not going to run it towards an exit. You just want to run a business as if you're never going to sell it, because, ideally you're going to find a smart buyer and they can tell. And so the way to maximize the value is always to look for the long-term value maximization of the business. So at least this is what we believe in. And yes, we operate in a very different market. Clearly, in markets like Turkey and Russia and some other developing markets we look at, they're not as competitive, first of all, partly because there isn't demand, that much purchasing power. I mean, London has tremendous purchasing power, so you can, if you do something right, you will be rich. But in other markets, they don't. So the consumer is much more focused on value. And I think the biggest learning for us in these developing markets is the successful entrepreneurs in developing markets figure out how to get a lot done with little capitals. And that becomes a big competitive advantage, because especially international chains and brands, they come in, they think, okay, you can put up a box for $500,000 in the US and make money. If you put up the same box for $500,000 in Turkey or Russia, you're not going to make money. That's not going to pay back. So if you come with that approach, you're not going to grow, and the local guy will beat you to it. So I think there are many other examples where there are differences in labor costs. So in developing markets, you can have more labor-intensive models, whereas in developed markets, we just discussed yesterday, you want to have less labor-intensive or more automized models. So these markets, therefore, differ significantly from each other, and the skills to be successful, in our view, in those markets versus these markets are quite different.
Just get back to your original question, what the break points are. I mean, with Yo, we bought and sold at 10 sites 25 sites and 75 sites. And that was because the investors' appetite, I think, over that time span, it was outside the comfort zone, and they wanted to sell to a bigger house who it probably was more appropriate to be the backer. And I was the CEO of the business, and it kind of made sense. It's like going through the football divisions until you get the Premier Division. And it's just, and we are basically representing many, many people who invest in our funds, and they have a time horizon as well. Yep. And their level of appetite, and risk depends on the size of the fund as well. I think that you move through the stratas of investors, and hopefully you find people who can add value along the journey. Because what we're doing, you're doing your stage, and I do my stage, and you're doing your stage. They're slightly different sort of management. Knowledge we can add. We haven't mentioned property, and I would say that's one of the biggest things. Which we have a lot of property people here at the moment, and I think without their help and their support, we don't get very far. There's a lot to learn with the property world.
Yeah, 50% of this business is property.
Well, on that point, what I would say is, what we believe is a successful franchising model is key to developing the right property, in our experience. Because if we have successful franchising model, we have many, many franchisees or potential investors who want to come in because they can make a lot of money with our format. That means we have tens or maybe hundreds of people always looking for the best location for our concept. So franchising model actually can be very powerful in securing the right property for your brand.
And Ahmet, as far as you just mentioned, you look very careful at your investments, and you do your due diligence.
Yes.
You have your interviews with management, and then you would like to take decisions on your investment. What we see, especially in the larger chains, that also the sale process for franchise formulas are being organized in auction processes. Is there in your market still room for, let's say, a careful bilateral negotiations to make sure you do a proper investment, or is there a lot of pressure also on the market?
So I would say in 2 out of 3 situations, we came and partnered up with the founders.
Yeah.
We did acquire the majority, however, founders stayed in. And look, successful F&B businesses, frankly, from what we've seen, don't really need that much money to grow. Their payback period is good. They can grow slowly. We can speed that up with capital, but what they're really looking for is the right partner to help them scale the business and take it towards an exit. In one case, we acquired 100%, in which case, it's an auction. So really, whoever believes they can do the most with the asset. But so I think the answer is typically if the founder entrepreneur is looking to speed up the growth, institutionalize the business, take it to a more corporate level, and then eventually exit, then they will look to partner, and they're not going to look at purely on valuation and so on and so forth. They're going to look for the right partner to maximize the value. In other cases, shareholders simply want to exit. They're going to put it up for auction. Then best man wins. So,
guys, in your experiences, when you exit, do you have a preferred method? Is it a secondary to another PE? Is it a sale to strategic or an IPO even, depending on the size?
Well, we haven't exited anything, so we got five investments. It depends. I mean, it depends on the time. And America's different to the UK, and we're doing something in Italy that's different. Best deals, in my experience, being the other end, are done quietly and discreetly, and not through a blazing auction. Because much better for the founder and the management team if they're also part of that decision-making process. I think that's what you try and do. You try and make sure everyone's a winner. And hopefully, the next buyer can bring something the seller can't give the management team, and it becomes then a mutually delightful experience because everyone's going to make a bit of money and move on to the next stage. But there are some businesses that you have to auction because they're too hot, or or perhaps that's what everybody wants. But IPO is an interesting one because the rule of thumb is in the UK you shouldn't do it unless your valuation is over 100 million. It just isn't worth it. I sit on a PLC board. You've got an ocean of pain coming. You have to take on board a lot of cost and a lot of corporate governance. So that's one option, but it's one you shouldn't do unless you're big enough and grown up enough.
I would even say you don't want to go for an IPO unless you're going to get like a $400 or $500 million valuation.
Okay, numbers gone up. Yeah.
You know, you're not going to get a decent. Decent set of institutional investors are not going to get involved.
Yeah, so shares won't trade, and you're stuck with something.
But for public markets, you know, for a scalable chain that has the right structures, processes, management, etc., is actually a very, very attractive public company, in my opinion. So I think if you can reach that size, the examples are out there. These companies are trading at really, really high valuations.
I mean, the real shocker for us in the UK is the valuation achieved on Wagamama's and Costa Coffee. I mean, they're spellbinding numbers, but there were strategic buyers in both cases who felt a compelling need, overpaid for both assets, and that's great. But I don't think it's reality. I mean, you're not going to get 15, 16 times your trailing 12 months EBITDA. We have to live in the land of reality.
And you do see, especially at the early stages, founders valuing their business like it's a tech business.
Yeah.
And this is an operating business, and it's very capital intensive. Yeah. It costs a lot of money to open a restaurant, and it does cost a lot of money to expand them. So I have a lot of quite entertaining conversations with founders on their valuation.
So again, I think that's a great point, and maybe it's worth separating the business models into franchisor business model versus corporate restaurant business model, because corporate restaurant business model clearly is capital intensive, but the franchisor business model is virtually capital free. And once you get that going, then I can see an argument, a thesis for why it's not very much different than any type of penetration story, whether it's technology or other consumer good. It can scale if it's a global concept massively, and we've seen some examples of that.
But then you stay away from the leases on your balance sheet to make sure.
Sure, for sure.
Yeah.
Well, there's a balance sometimes. You definitely don't want to be detached from actually investing in operating restaurants, right? That's the wrong culture in our view. But you can do 5%, 10% of your restaurants. Corporate, the rest can be franchisee, so you don't need capital to grow that business.
Well, I mean, speaking of exits again, one discussion we had with Kuif is the private equity exit is slightly different than a strategic sale. You're less amenable to standard categorical reps and warranties. So does insurance come into play? Do you think warranty and indemnity insurance is something that you consider, or more and more, or
we
less?
We would certainly consider the insurance, but because private equity runs the business with a view to exit without reps and warranties, just structurally, right? We're going to give the money back to our investors, and we may not get it back. So realistically, that reps and warranties may not be worth much. So therefore, we're running the business to make sure the business is clean in all aspects. So the buyer doesn't need the reps and warranties. So it's a very different mindset than running your own business, where you could probably take some risks and overlook some issues because they're not material, but then they need to be reps and warranted. Whereas when we run it, we want to make sure that when you guys come in for due diligence, it's a clean sheet, so you don't need the reps and warranties.
So how does it affect your day-to-day relationship with the owner-operator?
So we basically tell them, listen, leave this side to people we put into the company on the finance and legal side, and they'll take care of it. Don't worry about it. Just focus on the operations, because that's part of life. It's good for everybody.
Mm-hmm. But in terms of processes, it's quite a difference between what you explained about a silent deal. These are the best, and people know each other well. They do their due diligence, and they partner up.
Yes.
Whereas if you go for the larger change and you want to exit,
yes,
it becomes a less people's deal.
Yeah, I would say, you know, one of the most difficult things in our business is we partner up with some entrepreneur, founders, or an individual. When you come to exit, if you're going to exit and they're not going to exit, it's a very uncomfortable position because inevitably you're not at the same side of the table. There are different agendas. So that's something we'd like to avoid if possible. It's not always possible, and we've done it otherwise. However, we really look into the eyes of the potential partner and say, look, are we really going to exit this business together in a few years? I mean, there has been situations, my previous firm, the most successful investment was a retail investment, and they held it for 13 years. So private equity is changing. Our investors are giving us more leeway to hold on to really successful, high-potential businesses. So we see private equity hold on for 8 years, 10 years, 12 years. What we're looking for is every year, can we generate another 25, 30% return on what we already have? If we can, we don't want to sell it, believe me. That's a lot of money we can make off of that investment. So it's not a short-term investment business in our business, but eventually we will exit.
Do you have also examples, and I know that from the Turkish market in different sectors, that private equity is doing it so well that ultimately the founders, they buy back the stake they have sold to the private equity at the end?
That's generally when the private equity hasn't done so well. I would say. You know, if we've done well enough, the founder cannot afford to buy us back. So I think that's the answer to that.
Well, that's about the time we had for the panel discussion, but maybe any questions, any remarks, anything you'd like to poke our brains about? Do we have a microphone? Yeah, it's
We can hear you.
Faisal Khan from Zabardast in London. Normally when we're looking for funding, we have to do an elevator pitch. Since we have a panel here, I wonder if you could give us an elevator pitch on why we should partner with you.
No, good question.
All right.
Well,
Shall I go?
well, I'll start. I would actually say you don't have to. Simple case is investing, as it's like a marriage, and you don't want to just get into bed with the richest person in the room. Spend a lot of time flirting, chatting with different people, and understanding if you've got to have the same ideas for the business. It's a very personal thing, and raising the money is just the first stage. You are then in for 5, 6, 7 years, however long. So really do spend that time with the investor and working out yourself from both sides if it's the right partner.
So was the question about how to pitch, or us to pitch to you? I didn't get
Us
that.
to pitch as to why to come to us.
Why you should take my money? Because it's smart money. No, in our case, we're utterly differentiated. No other fund in the world has this money just focused on restaurants. So all we do is live and breathe. Is sweating the assets and understanding what's happening on food and technology and property and people. And it's very interesting. I've got all the CEOs, all 5 of our CEOs. The 2 of them just arrived in London this morning, and we go out with 2 from the UK, and then a guy from the Middle East. It's 5 of us. And we're going to go out and have dinner tomorrow night. And I just can't imagine it ever happening with my previous private equity backers. We're just very honourable and open and saying, why don't you just all discuss the key issues you have between you? You're all super bright, very successful, very rich, these people as well, and big egos to some extent. But actually they've got a lot to offer each other. So we want to be the go-to platform and probably the most colourful but successful entrepreneurial stable, as it were, of restaurant operators and not get ahead of ourselves. We just keep our eyes on the numbers, but actually remember this is a hospitable, fun business that you can have some fun while making money, and we don't see any boundaries in terms of forget Brexit, but we don't see borders. I mean, we spend a lot of time travelling the world, and I don't see the differences that other people see. All I see is opportunities. Most of our teams of management see the same world. They don't sit there being parochial or narrow-minded. So, I think we're unique. And it's just, we're 1 year in, we're 90 million invested of our 250. We've got another 150 to invest, folks. But we are basically being quite selective because we have to be. And I'm very respectful to our investors. Remember, I'm only as good as the return I give them. So I just sit as the middleman, trying to do the very best for the people invested and put faith in our business. Just so you're aware, and people aren't aware, we spend a lot of our time fundraising. So you think pitching is hard? You try doing 100 pitches like I did last year to actually get money in. That makes you very, very respectful, I think, of people who are trying to look to us for money for their business. We're doing it all the time behind. We've already done it to raise the money to invest in the first place. And I know how hard it is because I had to pitch for Yo many, many times. I mean, 50 probably presentations over a few years, and it's painful and hard work. But eventually, just like getting married, you'll find the person you feel comfortable and feel you can have a long-term relationship with. And the only advice I give anybody is trust your gut. And I think that you just know when you're in the right place, the right time, the right people. And there's only so much you can actually negotiate. But something inside here will tell you this is right, and I should get on with it now. And it's serendipity when it happens.
Well, I would say you want to. Typically, the entrepreneurs want to reduce risk. If they see an opportunity for a huge growth, it generally involves some financial and execution risks. So what you want to look for is someone who's going to significantly increase your probability of success. So that's, by definition, either partial cash out of your business, so that even if you fail trying to get bigger, you'll be fine, and partner up with someone who has the same vision and has been there managing a growing business before. And I think entrepreneurs should not underestimate the fact that most best professional teams tend to want to work with institutional investors as opposed to entrepreneurs. At least in developing markets, that's clearly the case, because they know and they're right that the institutional investor is much more disciplined about strategy, execution, targets, and so on and so forth. Whereas, a founder, entrepreneur, owner of the business, they can decide to buy a boat and take the family for a holiday instead of opening the next restaurant, right? But private equity is never going to allow that. So for professionals to come into a firm to help to grow the firm, it's big comfort to have institutional money in.
All right. Thank you, everyone. Conscious of the time, I think we'll take our leave. It's been a pleasure. We'll see you around.
Thank you.
Thank you, guys. Thank you.